My name is Steve Goldberg. I'm with Finistere Ventures, formerly with Venrock. I've been a venture capitalist for coming up on 13 years. Well, I think, first of all, they should think about their motives. Uh, Many people obviously think about, capital returns, making money. Some are strategically driven that if you were involved in the wireless industry or you were involved in the financial industry and you kind of have an affinity for those kinds of technologies, you might want to pursue investments to see technologies there. Other people, if you're involved in an industry, actively involved, and you feel strategically that you'd like to be closer to new developments, making investments and being part of new companies might give you an inside track as to what's going on. I would say, first of all, to get involved, it's non-trivial to get your money into a given fund. I mean, typically you either have to have some sort of formal relationship, maybe some sort of minimum investment amount, which might be relatively difficult. Investing as an angel, I think there are a number, globally, there are angel groups where they draw entrepreneurs to pitch to a larger audience, and you have opportunities to meet with people who identify as people who do technical diligence so that you can share that information, see how other investors get involved. So I would say probably try to find an angel group first to kind of learn the ropes. When LPs get involved in venture capital? Well, I guess it's only a mistake if they're off their thesis. In other words, if you're interested in making money, you need to sort of identify the highest probability investments that are going to, provide returns. If you don't recognize it as maybe an alternative asset class, many people that I know, a lot of the large LPs that I know, use it as an alternative, an option, not looking for an all or nothing kind of return. And I would say, just adding to that, we're talking very long time frames here. We're talking 10 to 15 year type investments, investing in themes or some core thesis. So if you think it's a get rich quick approach, probably not a good idea and probably a mistake. The other things I would say generally is, when you're doing business with anyone in any kind of business setting, know the people you're investing with well, understand what their motives are, and hopefully they're aligned with your own. Well, I would have to say our firm is really financially driven. So there's a lot of factors that we would look at for a given investment. The classic venture capital questions: the team, the technology, the market. But in terms of why we invest as a whole, we're 100% driven by returns. There's really a very singular metric by which the fund is measured. Either cash on cash return or IRR to the investors. Good question. I would say, our, let's say, average first meeting to writing a check would probably be about a couple of months. So 2-3 meetings to get to know the team, another few meetings to do diligence, and then probably a few more meetings to close a deal. So I would say 6 to 8 weeks on average. Well, I have an opinion that really hasn't changed much in 13 years, and that is because these investments are made, I think the good investors recognize that it takes a while for companies to grow. So the typical statistics are what, 6 to 8 years for an M&A, 8 to 10 years for an IPO. I don't think in the last 20 years the VC landscape has changed dramatically. I typically think of a grayscale, everything from angel investors, corporate investors, VCs, venture capitalists, I think of sort of as the center of the sort of Series A, Series B, Series C. Then you've got growth stage investors and private equity on the other end. So when someone says venture capital to me, I think of sort of professional financial investors in the middle. I don't necessarily call angel investors venture capitalists per se. I sort of separate that term. I actually would say there's been a lot of press about public markets. You know, we've had fears of recession in the United States, global concerns, the public US markets are down. But I would argue in early stage investing, there's several $billion that has been allocated over during the run up before we had this last decline that's been allocated to early stage investments. You've got billion-dollar seed funds. So I wouldn't be so quick to say in 2022, where we are now at the end of 2022, that valuations are down for early stage companies. Good companies get funded, and there's still plenty of deals getting done with two entrepreneurs and a dog in a garage with $20 million pre-money valuations. I don't actually see, I think late stage deals that are closer to exits, clearly valuations are down. But the early stage, I think the best venture capitalists, the best investors recognize that good deals are hard to find, and good investors pay for good deals. I think my biggest takeaway is good deals are hard to come by. You have to be very close to the industries where you invest. It's incredibly difficult to be a generalist. You have to know too many things too broadly, and you're not anyone's first call. So if you're a specialist and you really know a market, when somebody's got a new idea, they call you. And so I think what I didn't realize was the scarcity of great deals and the challenge of developing yourself into someone that in given markets, you're one of the ones that gets the call to get an option on whether or not to do that deal or not.